2025 is upon us, and that's probably the best way that we could possibly start the show, which is what do we expect to happen in 2025 in mortgage rates and real estate. But today we're going to talk about the big factors that are going on that are going to impact the marketplace and what this could mean for you as a borrower or someone in the marketplace, or if you're someone in the real estate industry, how this might actually impact your business. There's a lot of stuff to think about and talk about here today. So we're going to talk about Canada's economic outlook, what's going on there and how it could impact mortgages, from the disinflationary forces to the reinflationary risks, evolving regulations and new rules, and what these could mean for fixed and variable interest rates. So we're going to break down with hard data and specific things that have actually happened in 2024 and what could happen in 2025. And do not forget to stay till the very, very end, because I'll get into my specific rate predictions, what you could expect, and what the marketplace is suggesting might be a surprise for you in 2025. I think it's first very important to set the stage when we're talking about Canada's economic cross currents, all the different things that are impacting the marketplace, pulling up and pushing down, that could impact mortgage rates and real estate. And I broke down the top, 6 different factors which could cause disinflationary forces, but at the same time, the reinflationary risks are very real. So I broke down the top 6 factors that we might need to look out on that front. But let's just break this down. First and foremost, Canada has a serious cross current going on economically speaking. We've got conflicting information and evidence, and we're in a really weird spot right now where we went from rates going up at record highs from 2022 to 2023 to now having seen interest rates go down 1.75% from the peak in just 6 months, and fixed interest rates themselves having gone down 2%. Suffice to say, the market is a little bit of an interesting place right now, and most people are trying to figure out what the heck to do as it relates to things like renewals or getting into the market. And some people don't know or don't care, and they're not watching this, but they'll probably end up spending more money anyways. So let's just get into it first and foremost. With the economy showing both disinflationary and reinflationary pressures, here's exactly what the data is showing and some of the information that you need to be aware of. Now, first and foremost, let's just break down the list. When we talk about something like disinflationary forces, this is bringing down the cost of living. This is bringing down the expenses. This is based on the assumption that a lot of the work that the BOC and the government of Canada is doing is actually having a positive effect on our cost of living. Now, first and foremost, the population declines that are expected to happen in 2025, with Canada's annual population growth expected to go down from 3.1% in 2023 to just 1.8% in 2025. The marketplace is suggesting this could have a very significant impact on not only the uptake on real estate, but also just the overall aggregate consumption of goods and services within the country. But moreover, the fact is, a lot of these people that are leaving our country are skilled laborers or skilled people that we're looking to keep in the country. And even if they're not, it's going to have an impact because, of course, the housing supply and demand considerations alone will suggest that, well, we don't have quite as many people to house, which means we're not going to have that same level of demand, which is not completely factual and true, but it doesn't put the same amount of pressure as it might have put on it previously. Now, another disinflationary force, this is an obvious one, and it's been talked about it in some of our predictions, is the proposed Donald Trump-led U.S. tariffs on Canadian goods. Now, this idea could reduce exports and really lay the hammer down on domestic spending for a lot of different reasons. I mean, first and foremost, it's going to kill a lot of businesses. And if it doesn't kill a lot of businesses, it'll absolutely hurt them. In addition to this consideration, if you're thinking about tariffs, this could hurt and swing both ways. So not only is it going to make things more expensive, or will it make things more expensive as a Canadian and a Canadian business owner, but it'll also make things more expensive in the United States, driving the cost of goods up and reducing our exports, therefore negatively impacting our overall economy. Now, the third one's a little bit of a wild card, and something that we've talked about before, and you probably don't seriously consider it, or maybe you do, I don't know, but I don't think enough people are actually seriously considering the potential impact of AI-driven productivity. While some of y'all have been sleeping, AI has not been, and it's been growing at such an insanely rapid pace that it's taking over jobs on a daily weekly, and a monthly basis. And it's reframing how we operate, how we think, and what we do. I mean, case in point, half the time you're no longer typing into Google, you're typing into AI and asking it questions versus typing into Google. Heck, even as a mortgage broker, people are asking AI questions and then coming to us for advice around how to support the answers to those questions. So, point is, depending on what happens with AI, the advancements are predicted to cut costs for businesses around 10 to 15% in many key factors, specifically things like manufacturing and tech, which is going to lower potential prices across the board, assuming they pass those savings on to consumers. Now, again, we're talking about disinflationary forces. This is based on the assumption that they do pass those reductions in cost down to consumers. Chances are they continue to keep those profits. So again, very unlikely that unfortunately works in our favor, but it is something to think about. Now, the fifth one is one that you probably have thought about before, which is mortgage renewal shock. By mid-2025, 60% of Canadian households with mortgages will renew at rates averaging 20% higher than their previous term. I think the average person who took a mortgage in 2020 was around 2.5% if they took a fixed rate mortgage. And with over 65% of people having taken fixed rate mortgages that year, that means 65% of people are going to see an average monthly payment of at least 20% higher. And that's going to hit by halfway through this year. And what I've learned is that it typically takes people about 6 months before that works its way through their budget and it actually becomes a noticeable consideration. So I don't think that this is going to have a huge impact for 2025. But I do believe that in 2026, this will have an impact on the marketplace. Of course, it's going to reduce people's disposable income. You were making more money between 2020 to 2024. You started making more money, and now this is kind of taking away from that bank. So there's less money to spend. The last consideration, the last factor that could cause things to be disinflationary in our country would be just overall global growth concerns. Slower growth in China, Canada's second largest economic trading partner, that is, of course, is expected to shave off a portion of Canada's overall GDP growth. So with that growth being reduced in China, this could have a major economic event or impact on Canada, which again could cause disinflationary factors. Now, why are we talking about this? I'm just gonna break this down. Why are we talking about disinflation and reinflation? The first thing is that this is one of the backbones of how BOC makes decisions as it relates to things like the Bank of Canada's overnight rate, and that directly impacts how much money that we have to spend. It directly impacts the real estate industry. It directly impacts consumers and businesses day to day. And so the concept of inflation and disinflation might not be a sexy conversation to have, but these predictions and these factors are real as it relates to how much you're going to pay going into next year. So let's just bandy through some of these reinflationary risks. So this is the stuff that can make the pot boil over. This can bring our expenses right back up again. The first factor which could invite inflationary spending is one that's not shocking or surprising, and there's actually two. It's kind of like they work together. With the BOC having reduced interest rates, Bank of Canada itself has injected a whole bunch of money back into the economy. So people have spent a whole bunch of money because their mortgage rates are higher, they were spending on interest. Well, by dropping rates 1.75%, they brought a whole bunch of money back into the economy. Those people have money, they're going to start spending that money, and that could reignite inflation right there. Followed by number two, which depending on the way you look at it, this could be number one, which is fiscal stimulus. The government spending money hand over fist, everything from the GST holiday to all these different guidelines or different programs that they're bringing out. This could have a serious impact on our overall economy and reignite inflation. Oxford Economics predicts another round of federal fiscal stimulus, which basically says at least $10 billion is going to be allocated to infrastructure and healthcare spending in 2025, which on its own is not necessarily a bad thing. But when you're spending more money, you have the fear that you're going to continue to reignite overall inflation in the marketplace, and this is going to potentially increase costs. The third one is actually funny because we talked about disinflation, well, reinflation, AI business investment. So with businesses using or projecting to use and spend more money on AI-related investments, most businesses suggest at least 25%. This is most likely going to drive demand in sectors like cloud computing and advanced machinery. So again, this could increase inflation by increasing the overall cost and the money that's being spent. The fourth one, this is something that we're not talking about enough these days, and this is actually kind of a sneaky one because it kind of works in two different ways, which is the weak Canadian dollar. We're sitting at 68 cents USD at the end of 2024, which is brutal. That's rock bottom low. And it's making imports expensive, and it's fueling inflation across the marketplace. It's increasing the cost of living. Now, it's increasing costs overall from a business and a personal perspective across the board. And you got to watch out for that, the US dollar, because again, that could have a very noticeable rise. And one of the ways it actually is working for the real estate market is that we've got Americans looking at that US dollar and saying, hey, let's go buy in Canada. And so we're actually seeing some of these submarkets in Canada where they're not required to worry about things like the speculation tax and or some of these other taxes that are out there, short terms and so forth, buying in these tiny communities or small communities for very low costs in ways that they couldn't have done before. Fifth one is wage growth, with Canadian wages having gone up 6.8% year over year in the Q3 of 2024, which is crazy. That was double the inflation rate of 3.4%. And so if wage growth continues to grow at that amount, and it might happen, like honestly, with the cost of living going up here, with wage growth going up, this could have another inflationary effect in Canadian mortgages. And the last one being Canadian real estate overall resurgence. Now, despite the high rates, real estate transactions themselves increased by 12% in late 2024, which is due to the pent-up demand in most cities like Vancouver and Toronto, as well as investor-led activity. I'm going to stop and speak on that for a second right now. The idea of real estate resurgence is not just an idea. This is a real thing. There's only so long that people will hold back and sit on the sidelines and stop living their life because of what we perceive to be higher interest rates or quote unquote a not good market or real estate market. And the reality is people out there want to buy. They don't want to sit on the sidelines. They want to get into the marketplace. And that's been proven because October, November, and December were all strong months after a low season in September and August in particular. It took a while for the market to kick back in, but when it did, it has been above market share for the last couple of years, at least since 2021. So this all leads to the question of the mixed forces creating a significant uncertainty for the Bank of Canada's rate path and mortgage planning. But let's talk about how this actually impacts the market rates, because that's what you're here for, is what's going to happen in mortgage rates. Now, we need to understand first and foremost how the fixed rates and variable rates differ so that you can understand the two. But for the sake of conversation, let's talk about variable rates and where they're at right now. Now, the Bank of Canada's rate cuts in 2024, it brought us down from 5% to 3.25% from July to December. So in 6 months, there was a significant drop in the marketplace, which brought down interest rates 1.75%, very significant amount at the end of the day. The projections for 2025 as it relates to interest rates on the variable rate side really vary, but not every bank has come out and given their predictions. Nonetheless, they're kind of across the board from the ones that we've seen. Now, the revised predictions that are starting to come out now from, let's say, for example, BMO predicting the overnight rate will drop to 2.5% from today's 3.25% by mid-2025. So they're expecting a 75 basis point rate drop, whereas Scotiabank is being much more conservative in their predictions, suggesting that rates themselves could be forecasted at 3%, which is only a quarter point drop from where you're at today. So if you were a variable rate holder and you took your rate, call it 4 to 6 months ago, and you got anywhere between prime -1 to prime -75, if it only goes down a quarter point, then you're probably sitting approximately where you would have sat if you had taken, let's say, for example, a 3-year fixed rate, but you'd be in a variable rate. So it would have been probably a reasonably safe bet, all things considered, that rates came down within 6 months to where you were hoping they came down to. So if they come down 75 basis points, this is going to put prime in a much better position for most people who are sitting there with variable rates to see their actual variable rates, if not only in the low 4s, in the 3% range. And that's where the bet really pays off for those variable rate holders. So what is the impact to you as a borrower? The question mark most people are really asking, do I go fixed or do I go variable? Well, let's get into fixed rates and what's happened there before we talk about which one you want to go with. Fixed rates, the current trends right now, bond yields hit a rock bottom there in October of 2024. And basically since the election, they've shot right back up to about 3% range. They've come down about 1.5% at the peak from about a year before, but because the yields have peaked back up again, and we're now hovering around that 3% range, most are expecting that fixed rates will remain in that 4.25% to 4.75% gap, somewhere in that range within a quarter percent, basically ongoing. Most economists who are being honest with you will tell you that their predictions are only as good as about the next 4 to 6 months. And most are suggesting that within 4 to 6 months, it's either the same, a quarter point lower, or a quarter point higher. So if you're on that fixed rate bandwagon right now, there's not really a lot of opportunity for additional savings over and above what you're seeing right now. And the really question mark there is to obviously find the best type of program and structure for your situation. Also, of course, if the market changes, you want to be able to take advantage of that. So you want to be conscious of things like prepayment penalties at that time when it comes to fixed rates. Now, the bond yields themselves could have a significant amount of volatility in the marketplace going into 2025 with Trump taking office in January, with the potential of the tariffs going to take place and other potential economic events that could occur that we don't even know about right now. Obviously, that quarter point up or down sort of range could vary depending on what happens economically speaking, but based on what you can see right now, there's no real reason to believe that they're going to change very significantly in the near term. So the big question for most people right now with fixed rate is, do I go with a fixed rate that has a stability, especially for something in a renewal where someone's taking on rates that are already higher from, let's say, 2.5% to 4.5%, or do I go with a variable rate that could appeal to someone who wants to take advantage of the potential 3/4 of a point rate cut that comes in the marketplace in 2025, but maybe a little bit of discomfort because of the fact that we might see those short-term fluctuations in the marketplace. So the question about those two options is probably going to persist for quite some time right now. But the one thing I would caution you is, if you're a variable rate person, you want to take a variable rate, if you wait too long, we could see the banks start to get rid of some of those discounts, especially if the Bank of Canada continues lower rates, because many of these banks will kind of peel back and not want to give the amount of, discount that you will off of prime looking forward. Now, some other predictions looking into 2025, some things that are going to change the marketplace would come down to, number one, the regulatory changes. So the first one is, what is going to be the impact of that stress test change? We went from the stress test itself being at as much as 6.5% to 8.5%. And now we've seen the stress test come all the way down to around 6 to 6.5%, which is significantly lower. And that's happened over the course of the last year. So for those who got, let's say requalified or qualified for a mortgage in the beginning of 2024 to the beginning of 2025, they can qualify for somewhere around 10% more money because of the fact that the stress test has come down, which is helping people with a little bit more qualification. The second consideration here is the insured mortgage rules. And this is probably the bigger of the two. The insured mortgage rules changes says that anybody who's a first-time buyer can get into a property in 2025 after December 15, 2024 with a 30-year amortization, which increases borrowing power by approximately 8% depending on someone's exact situation. So if you think about that, that's $8,000 for every $100,000 that someone's borrowing there. 8 times 5, that's $40,000. So what we believe is going to happen from that is it's going to increase the floor price point for a lot of different communities and cities over the course of the year. And while that might not be an immediate or a direct impact day one, it will happen, and it is going to increase the demand for some of those lower priced properties as people can get their way in. But I believe what's going to happen from that is just going to increase the price floor in many situations. Another few interesting factors to consider here would be the insured refinances returning in 2025. No one's talking about this, but this is a sneaky little thing when you combine this with the government's second home or suited home second program, where they're giving away money at around 2% interest for you to build up a secondary suite at $80,000, so up to $80,000. You also have the ability to finance up to 90% of your home's future value by adding in a basement suite. So kind of like a construction loan using CMHC. This is something that's going to be, I think, initially speaking, people aren't going to know what to do with this program because it's something that's unique, and you're going to have to look at some different strategies and tactics to use it. But I do believe there will be some uptake in this program, and you will see more people start to jump into it over the course of the second half of the year, which could impact the marketplace for those looking to buy single family suitable homes, which is another one of the reasons I keep talking about single family homes that have the ability to be suited and or are purchased in areas where they're good neighborhoods, but maybe not the greatest house, because I do believe that equity growth in those properties will be significant over the course of the next few years, especially when density continues to grow and we see less and less completions looking forward into 2030 because there's less building going on right now. Going forward into 2025, we've also got these no stress test switch rules coming in. As we talked about, the refinances, the additional suites. We've got NDP coming out with different programs. We've got home flipping taxes. Basically, the short version is there are so many different regulatory changes coming into 2025. The question mark we just want to ask right now is what's next? What's going to happen next? And how is that going to impact the marketplace? Because we've seen that by taxing and regulating the heck out of the marketplace, it doesn't do anything as far as reducing house prices. It continues to just put pressure on people who are buying homes and increasing costs. When will we wake up and stop increasing the cost of building and start looking at that as one of the primary considerations? Is my biggest question as it relates to that. So what kind of predictions do we have? 2025, 2024 was crazy. I mean, I think most people thought that the rates would go down around 1.5 to 2%, and that happened, 1.75%. Most people thought it would start sooner and end a little bit lower, but it did take longer. And then we ended up seeing two jumbo rate cuts at the end to kind of bring us back to where we were thinking. A lot of people also thought, by the way, we started the year that we would have seen real estate markets start to slowly come back this year. And it did towards the end of 2024. The question for many is, does this have an impact on real estate values going into 2025? And are we going to see the market really take off in January, or are we going to see another one of those like firecrackers where we see a little bit of a pop and then it slows down again while people have to make up those renewals? Now, based on the marketplace, the rate predictions right now, variable rates are expected to hit that to mid 3% range, making them the best choice for cost conscious borrowers. I guess my prediction, if I have to put predictions on the board, is less of a prediction, but more based on what I've read and what I know about the economy. I think that we see a 75 basis point overall BOC rate drop, making a variable rate the smarter decision on paper, but of course not a significant spread for most people that are getting into the marketplace. And by the time that we see the 75-point rate cut, it could be the end of 2025, which means that the variable rate would have edged out that fixed rate borrower, but not by a significant amount, which is interesting. Fixed rates, based on the way things are going right now, I would anticipate that the spring market sees even just a slight reduction unless something significant happens, maybe around 0.25% to bring those fixed rates down to 4.5% range. That spread, depending on if it's an insured mortgage or an uninsured mortgage, with a couple different lenders probably making splashes in those 3.99% with those teaser rates that you see out there. From a regulatory impact perspective, I predict that the stress test exemptions will not make refinancing significantly easier for borrowers. And I think that combined with the new LTI requirements, which we didn't even talk about here today, is going to have a negative impact on people's ability to refi in 2025. But I also believe that we'll see a significant amount of people applying for refinances and wanting to work with people who are well educated about these refinances outside of the banks. Of course, that is because I believe that many of the banks will not be able to finance them, and they will be way too freaking busy to keep up with the business, which means you're going to see a lot of folks slip between the cracks when it comes to purchases and refis, and just a lot of balls being dropped in the overall marketplace. From a strategic perspective, if you're a borrower trying to figure this out, if you value stability, obviously we have to look at it at that time. Run an amortization simulator or ask your broker to run an amortization simulation between a 2 or 3 year. If you're more of a stable type of person at this point right now, if you're a little bit more risk tolerant, then of course you might want to look at a variable rate. Just make sure you know the difference between adjustable or a variable rate. An adjustable offers lower monthly payments if rates go down. That's a floating payment. A variable rate, of course, has a fixed monthly payment, and so you don't have to worry about that happening. So those are the two different types of options to kind of look at. So some key influences to watch out for as it relates to predictions that I would be looking out for. Number one would be the US trade tariffs that are coming down the pipe. A 25% tariff could absolutely decimate us and could cause inflation to spike significantly, which would cause obviously the BOC to lower interest rates. I'd be watching a resurgence in real estate transactions, primarily speaking on that entry-level price point. And in addition to that, in that single family home detached marketplace, which is where we're most likely going to see demand outpace supply and eventually start to see house prices go up in many major cities and communities, with many of the sub communities taking a little bit longer for the market to stabilize and start to work its way back up. And lastly, I would see that persistent wage increases might continue to unfortunately fuel inflation, which would keep rates elevated a bit longer than expected, but still hitting that 3/4 of a rate drop on the way down. So those are my big predictions for 2025. I'd love to get your feedback. Do you think I was completely off? Do you think that this makes sense? What are your thoughts on the rate predictions? Leave some comments below or hit me up on Instagram at Flow Mortgage Co. or at The Mortgage Pug, because it'd be really helpful to get what your feedback is. Oh, and two more things. One to give away for you. If you are a first-time buyer trying to get into the marketplace in 2025 and it's your year, just go to my Instagram page, hit the link in my bio. You can get access to the free masterclass, which has 17 particular modules just for you. Number two, if you are somebody looking to do a financial checkup to figure out where you're at, we'll have a podcast coming out, but I have a complete checklist that breaks down all the areas of your personal finance and more specifically, your mortgage and real estate portfolio. This can set you up for success in 2025. Just go ahead, find me on Instagram and send me a DM checklist. I will send that over to you. Have a fantastic rest of your day, an incredible new year, and make 2025 the best year of your freaking life.